most people, it takes a long time to go to $1 million, right? And you're like, oh, real estate's safe. And okay, look at this. And my nephew is works there or whatever it is, right? I'd rather underpromise and overdeliver. And you fix the debt. You're having to raise more equity today. That's a fact, right? Fortunately, we're able to do that. And you know what? It's just real estate. You keep it simple and it cash flows. It provides great tax benefits and it's going to appreciate over time.
I feel like we were in this hyper competitive market pre-COVID, but that rent growth, something happened during COVID. We're seeing inflation, government printing money, and also for one of the first times ever, everyone's at home all the time thinking, where do I want to live? And so we see this like people moving into nicer apartments, spending more money. And I think that was really the kickoff of these really huge exponential growth in rents that were being pegged.
Welcome to another episode of the CashFlow Quest, everybody. Today, we've got the panel group, Tide Eldridge, Ben Schuster, I'm Jen Purcell, and of course, my brother, Blake Comfort. And today, we're going to have some fun and talk about, we're in some untreaded territory here with what did we call this? Like the kickoff of a new era of debt and multifamily, and we're going to have some, Blake's making really funny faces right now.
The Multifamily Meltdown.
The Multifamily Meltdown.
And as my son would say,
And, there's a lot of people that took floating rate debt that are in big trouble right now or trying to figure out what the hell to do. And so let's have some fun and kind of talk about this, guys.
I think we set the stage as a multifamily sponsor first.
With our history.
And knowing what we know from the beginning. And then we talk about like where they kind of took the wrong turn.
I like that.
Because it's important for people to know that I actually would give them the benefit of the doubt on most areas. And then it's like, it gets tricky after that. And honestly, it's because we haven't seen something to this level in a long time.
Yeah,
and so like what the older guys that I try to listen to say is like, you gotta understand the whole 20, 30 year market cycles. So, okay, we're back in 2019, 2020, let's call it 2019 before COVID, because that's a whole nother issue. So rates are at all time lows, kind of 2019 going into 2020. And you want to buy apartments and it's really competitive, from a purchasing standpoint. And like, there's a bidding war going on every Class B, Class A multifamily asset, right?
Yeah. I would say some C product too.
And C, I've heard, but like there was always more of a specialty.
Yep. And Class B was the sweet spot.
Class B to like then go into a nice Class B, decent location, good bones where you could actually fix them up. Yeah. Like the multifamily projects we see around that of like, wow, that was pretty crusty and now it looks pretty nice.
Yeah. And like for vintage standpoint, this is like the 2000s, early 2000s vintage Class B properties.
Yeah, where maybe 90s.
Totally. Yeah.
And so it's like, okay, it looks good once you paint it and put a couple new touch points on it and then redo the units. And that was a really good business, and so you're in that moment and you're looking for ways to sharpen your pencil and be able to compete with the market. So everyone sort of ramped up this competition and drove cap rates down. And so then there was this debt game being played, meaning different loan products being played. So you had the standard agency products, but those would have shook down probably under 75% or even significantly under 75% in some cases because the rents in place were extremely low for the moment.
And just where cap rates were. Where they're getting bid.
Cap rates are getting bid down. Yeah. Rates are at like the 3% realm. Actually I think they were in the threes in 2018, even maybe back into 2017. So
they hovered there for quite a while.
They were 3 to 4 in that game in that moment in time. So then you're a multifamily guy, you're trying to buy apartments and trying to execute and trying to give returns that are adequate to investors, but you only want to raise as much cash as you need to in order for those returns to look good and honestly be good, because a lot of those guys had fully cycled deals at this point and they're moving. So they have a few debt options and more pressure, I'd say, came into the market because let's say the first guy that took a bridge loan that was 80 or 90% loan to value created a new trend in the market. And so then everyone starts taking that higher expense, higher interest rate bridge product which then created this new dynamic because they only had to come in with 10% down. So then their IRRs are still great. Their AARs, their average annual returns, their cash flows, everything's pretty good. And you're experiencing an operational like tailwind moment that has probably never been seen before.
Yes.
Where you are getting rents that you never even dreamed of. And every renewal you're going up, you're ratcheting up 10+%. Every time somebody moves out, you're crushing it on a release to that freshened up unit. Maybe even doing the value add strategy, making the unit nicer. You're going like 20% up on these new leases that you're getting. So revenue is spiking, revenue's going up and increasing in the right direction rapidly. And so it became this whole finance game.
And to your point is when you're looking at that, you're going to buy a new deal and you're saying, hey, year over year in the Sun Belt per se, our rent growth is up 10%. So what are we going to forecast on this B class value add strategy? Well, we're going to think that we're not only going to get to, the new market rate, but then we're going to grow market rate by maybe 5 to 10% plus into the future because you're taking the recency bias of what happened the last couple of years through COVID. And then you have interest rates which start to go up. The Fed is starting to indicate that they're going to increase interest rates. And so the market comes in with this floating rate product to try to subsidize and get the leverage to a higher point, which continues to put downward pressure on cap rates. So you're technically looking back, you're overbuying and you're making aggressive assumptions that if anything goes sideways, to which it did, you're in deep trouble.
And just to put a time marker, because you were talking pre-COVID and then you just hit on it. I feel like we were in this hyper competitive market pre-COVID, but that rent growth, something happened during COVID. We're seeing inflation, government printing money, and also for one of the first times ever, everyone's at home all the time thinking, where do I want to live? And so we see this like people moving into nicer apartments, spending more money. And I think that was really the kickoff of these really huge exponential growth in rents that, were being pegged.
And then the last piece on that too is that during this time, the developers are starting to spool up because they're seeing their returns, return on cost to go develop. And they're saying, hey, we want to get into the game and deliver class A, really high end product to the market because look at the rents that we could achieve. So we're getting a good spread on what we could build it for versus what we can go sell it for. And then so you had the developers coming in a big way and start building up that pipeline, which then all came online roughly at the same time, which caused concessions and oversupply short term, right? And that's what you're seeing today is just all that supply getting delivered to the market at one time. And so you have all these variables coming together at once and creating
then construction finance on an apartment building is typically an adjustable rate or shorter term, like 3 years, kind of on the what is a construction loan normally?
Yeah, it's like
maybe 3 years,
1 to 3 years. Yeah, of course.
Then you come out of the ground, you're leasing up, even if you leased up strong through 2021, 2022, rates now are like, you're thinking, okay, well, let's keep going on the lease up and we should be able to take out. Well, every time I remember being here, we were a seller, we were a buyer, and we were refinancing. So I remember where you thought like, okay, well, they're not going to raise rates again. Boom.
Yeah.
Well, there's no way they're going to raise rates again. Boom. And it just kept going to where they were chasing their tail. And then they got to a point when the Fed just kept going in that, I think it was 2021, where the initial spike really took off. At that point, they couldn't get out.
Yeah. The Fed funds rate went up 25 times. If you just look at it from that standpoint, I know you're going from basically zero, but it went up 25 times, right? SOFR curves, everyone's predicting like they're looking at a SOFR curve and they're getting in that floating rate debt. And they're like, well, look at the SOFR curve. Look, we're looking out 1 year, 2 year, 3 years.
And groups had stress test to a certain level that they thought was reasonable and conservative. They didn't think ever it would go up as much as it actually did.
And I think that's a good point that when you look at something like a SOFR curve or it's not fact, right? Like fact is like, hey, what is, market rent today? That's a fact. What's the median home price today? That's a fact. When you're looking at these forward looking curves, that's an assumption, right? You can't take that as a fact, because just because the market is predicting this is where SOFR might be or the Fed funds rate might be in 1 or 2 or 3 years doesn't mean that that is going to happen. And so that's where, being an investor, you need to hedge yourself against those risks.
And I think this is a good place for us to, if you're tuning in and let's say you're a multifamily operator, because we have a lot of operators who tune into the podcast. This is not us poking, you guys should have known better or this and that. I actually think we come from a place of understanding because we had adjustable rate debt. So why don't we kind of talk about what we saw? Because it was a really interesting thing to watch firsthand in the financials and the productivity of these assets. So let's kind of talk about our portfolio and how we saw it affect us directly. This isn't we don't know what's going on with you guys. Ha ha ha. This is, we dealt with it too.
Yeah, well, and I think it's worth note that like the Fed really did in the end go so aggressive in their maneuver to try to stifle the growth of inflation that they really, this kind of goes back to hasn't happened. This dynamic, I don't think has happened in commercial real estate, especially in multifamily, since like the late 80s, early 90s.
Yeah.
And so here we are, all of us in our mid to late 30s. Yeah. And and at the end of the day, our generation hasn't seen this.
No.
And so it's the younger, from what I can tell, the groups that are currently like raising the white flag, surrendering and throwing their properties back to the lenders are guys in their 30s and 40s who have not seen this unprecedented government swing in policy that really changed the whole game. Because even if they just were to slow the increase or like increase it half or 75% of what they did was so aggressive and so unprecedented in that moment coming off of the COVID dynamic. I feel for them. You know what? I'll be praying for those guys because I really don't believe they did it in a fraudulent and intentional manner. No, obviously they're going to lose everything probably. And probably go, bankrupt to those guys personally because there's too much going on. Lenders suing them, investors suing them. So yeah, to Tide's point, we understand that it's tough. So with that said, I was in charge of putting some floating rate debt on a few of our value add properties in that moment.
About 5% of our portfolio.
Just 3. So is that the same thing?
Yeah.
So just 3 assets got adjustable rates on them. And we were really blessed in that we were able to grow revenue and then just refinance out.
Right.
But it was not fun. And they pull basically the floaters, they have all this language in them. If rates go up, they can impound your operating reserves or any money that you have in your operating accounts. They impound them just like they would impound your insurance for the property and your property taxes. And they literally ACH pulled all your money.
For these rate cap.
So with it, let me back up because it's a really good and a weird point. And it took me probably 6 months to really understand the dynamic in talking to the mortgage bankers. When you buy an adjustable rate loan, you are required at that moment, you are required for 2 years of rate cap coverage, which is like an insurance on the loan rate. So it buys you a spread above where your current rate is, which was basically SOFR at 0, right? Or 0.5, whatever it was. And so you bought like 2% of insurance above your current SOFR level. So when the rates went up, that rate cap that you purchased kicks in as insurance and they reimburse you for the additional interest you're paying. But with that 2 years that you have, that's not very long, and so the lenders start doing quarterly calcs internally on the servicing end. They start doing quarterly calculations on what it's going to cost you to buy your next 2 years, which is required, a minimum of 2 years in place all the time. So then guess what happened to rate caps? They like 10, 20x on their cost to buy them. So now they're impounding money at an enormous rate. And we only had pretty small like loan to values. So it was even better than like a 70, 80, 90% loan to value.
Well, these were newer loans too. So like you didn't have enough time to grow your revenue or fill occupancy when when they pivoted to take these large ACH payments to, cover these projected purchases to, a year and a half down the road.
Yeah. And basically they could have pulled all of your money to execute.
Right.
So like depending on how much value add was there, that's what happened to one of our deals. We were going to floor a bunch of manufactured homes and do a deal. And they pulled all of the money we had set aside to floor the inventory.
Well, yeah. Can we walk through that deal?
Yeah.
So this was a learning moment for us. And I have this saying that I preach with our accounting team. It's operational misses are bad for business, right? If you have an asset and you're not filling up effectively, you're not managing the asset effectively, they're bad for business. They hurt the asset. Bad underwriting or bad loan and product kill the asset. So in this scenario, we have adjustable rate debt, right? What happens is we had an anticipation for an occupancy fill up and a flooring of units. And so with COVID, it was really interesting. Just to give an example, when the power company would send people out to do repairs and inspections, historically, they show up in a work truck filled with people. Well, during COVID, there was such a fervor and craze that people were going to get sick. They were sending them in individual trucks. So this is just an example, like one power truck used to show up. Now 3 or 4 are showing up. And so what you see is a delay in time. So our ability to floor inventory due to the raising costs of all the infrastructure materials, all these new guidelines of you got to wear a mask, you have to be separated for all of the construction, plus a doubling of cost of product. We had a 2-year phase where the cost of a double wide or single wide mobile home doubled, right? So basically our install time and cost gets extended, right? What we started to see on the debt side from chattel lending is if you weren't hitting certain install protocols, they put a global freeze on how much debt they would give on credit lines. So even if you had a $20 million credit line, you have to be hitting install timeframes or else you're not able to get the product, right? And so that we see a slowing of our ability to perform operationally, right? In the meantime, the loan product, so all of your underwriting is now shot from an occupancy and revenue standpoint. Now, in addition to that, on your balance sheet, you're getting crushed by impounds and raised costs. And so what happens? Your operating reserve just gets sucked out of the airplane. It's terrible. And so we had a scenario where we had a property where we had anticipated in a very short term that we were going to occupy. It was like 20 or 30%. And so what ended up happening is we start like losing our original plan over 24 months. As soon as the ability to install opened up, we floored the inventory and pushed hard. And we had already teed up a refinance with our loan team. And we were able to squeak by and refinance that deal and basically completely stabilize it. So luckily, we never had to do a capital call with the investors. We never had to, do anything that was too crazy. The deal is now stabilized. Did it perform to our expectations in the first years? No, but it still ended up being a win. But it was a Death Star moment. Luke shooting the AC vent and then it blowing up. It was a tough operational and balance sheet moment that we had, and I feel like I get it when I'm seeing this and we're talking about this. I'm like, oh,
but it's like we got double whammied if you're looking at the whole picture with floaters, because not only did costs go up substantially, maybe 2x right, on the CapEx side, like on just executing for like the unit renovations, the granite countertops, whatever they did,
everything
and the lead times and like everything just got so bungled in COVID because of the supply chain issues. So then like call that 2x. Then they're pulling your money's leaving the bank account to go to the lender to buy your next 2 years worth of rate cap. It was a disaster. And luckily we only had a few assets with it, but like those multifamily, to give everyone the right picture, the rates were 2% interest only, or 2.5% interest only. So like it was like one of those moments where you just get like punch drunk and you realize like, what in the hell did I just do? and they took it. Everyone took that 2.5% money. And it's like, I can understand why, but what should have been an overarching for like the 30 and 40-year-olds doing this, they should have like stuck somebody that was mature. I feel like in the end, how you sum this up is naivety. Like everyone was naive to this market risk. And if you put like a risk, somebody that was a sage advisor in their 70s, even just on a weekly call to be like, hey, here's what we're thinking.
Buy rate cap
like,
insurance.
You know what? Rate caps seem abnormally cheap, for the risk. And rates aren't going to go down. They can't go down from zero. So you should buy rate caps. And my dad, at that moment, being that he was in his late 60s, going through the realm of the early 90s in the RTC, him and I kicked this around. And he goes, how much for another year? And so we bought 3 years worth of rate cap coverage instead of 2 because we had a sage advisor who had seen shitty times. Yep. And he was wrapped up in development deals in the RTC days. Yeah. And so like, it's the same kind of version, just different, where like everything got shook so much. And the extra year of rate cap cost us, basically it was like $7 to $10,000 per year, depending on the loan, how much the loan was. So for our deals, it was smaller because they were $3 to $4 million loans. And so call it $10,000 a year. And then we ended up refining one of those deals and selling that $10,000 rate cap for one remaining year for $160,000 when we refied out. Because I saw the trend and I saw rates and I was like, well, I'd rather take a 5% interest rate fixed than take the chance of it continuing up. And it did. And so now it's like between 5.5 and 6.5 is kind of where things are at. And so that loan we took 3 years ago and refinanced out still is doing pretty good at 5, or actually it was like 2.5 years ago. So it's a wild time, and I feel for everyone that's caught up in it.
And I will say too, I don't think it's just the 30-something-year-olds. Like I know like Tide Equities is all over the press, right? $7 billion multifamily shop that just went BK.
Another one out of Austin is about the same size.
Yeah. And so I don't think, and actually I know it's not just those folks. It is gray hair individuals that do have the 7-year-old board and institutional investors backing it that made this mistake as well. And we understand how it could happen. I mean, if you lived it and you understand it, it makes sense to us how it happened. It's not that they're not smart or they're not sophisticated or they don't have their investors' best interest in mind. It was just the example that you just ran through culminated with what Ty just talked about, is that you have a capital markets issue that happened, but then now you have an operations issue. So you have expenses, you have insurance, you have repairs and maintenance. All of these costs are going up. You have vacancy that's increasing because you have a 40-year high of supply that's coming online. You're seeing concessions. You're not getting to your rent growth projections. Yeah. So it's like this culmination of all these bad, black swan events that are coming together that's causing this distress. And I think that's what we can kind of maybe go into now. It's like, will we now see the distress because it's been the extend and pretend? And now there's like $1 trillion worth of this paper that is outstanding. And from my conversations that I'm hearing is that the banks are becoming less willing to play ball and extending and giving these kind of grace periods with these operators. And I think it comes down to, 3 options. The first one is that you have to recapitalize the deal. So what does that mean? You go out to your investors and you issue a capital call. Maybe that's with the preferred equity, but you need to bring in more equity into the deal.
I'm hearing that that's going on in a lot of places.
A lot of our investors that are also in multifamily, I'm hearing it from. They call me and we talk, and they're so grateful that we've never issued a capital call, but they still believe in the deals and they're participating or trying to, right? So that's your first option is a recapitalization. The second option is what you're starting to see now is you go to sell it. So you say, hey, look, we know that this asset is not worth what we're projecting and we want to get out, right? And we have this floater on. So you're taking it out to the market and you're trying to sell it. And you hope that you sell it above the loan, right? But a lot of the times right now, what we're hearing from the brokers is that it's coming in below the loan, meaning that the entire equity is wiped out. And not only is the equity wiped out, but now you got to go have a conversation with the bank to see if they want to take a haircut or restructure. And then that leads you to the third is restructuring the debt with the bank. And so I think from what I'm hearing is that banks are going to be wanting to get their money back and taking back, these properties. And it's not every single multifamily deal.
That's option 4. The bank kicks down the door and takes it.
Yeah. Option 3. Yeah. The bank.
Yeah, they won't restructure. Then that
goes option 4. You don't want option 4.
Yeah. And so
A, 2, and D.
Yeah. And so in this option 4, and I don't think the banks want to operate. They're in the business of providing loans, not operating the assets, and that's why they have extended for so long. But I think it's coming to a tipping point.
I just am curious. what does the extension look like? Did they call the lender and go, hey,
so what we're
not going to be able to get out of this?
Yeah. And because like those caps or, those payments, they can't pay them. Right. So then they tack it on the back of the loan.
Right.
So the banks have been for like a year or two.
Yes.
Very flexible and coming to the table with renegotiating terms.
Yeah. And like, this is how I feel about it too. Yeah. And so that's what they would do. Right. So it's like, hey, like basically they're capitalizing the interest and they're putting on the back of the loan payment on the balloon. So then when you sell it or when you get out of it, you have to pay back that interest that they haven't been able to pay, but they're trying to extend. So they work it out. But what's happening, and I think today, with the CPI print coming out at like 3%, I think now it's like the writing's on the wall, because what people were thinking is that, hey, we're going to have a soft landing. The Fed's going to go and go on this cut rate path. And you're going to see the 10-year treasury or 5-year treasury or 7-year treasury, whatever you're benchmarked to, start to drop precipitously. And what do we all know now is that the Fed went and cut, a point or 1%. So they cut back the rate. See, inflation continues to be sticky. The 10-year treasury, if I just use that as a benchmark, hasn't been behaving the way that all market participants would assume it'd be behaving on a rate cutting path. Mm-hmm. And we're starting to see that decoupling of that relationship. And we're seeing that now inflation is stickier than we thought. We're seeing that the Fed has pivoted now in their remarks. They're not going to cut 4 to 6 times this year. It might be 2 times or it might be no time, right? And so that we think that the 10-year treasury is probably going to stay range bound around 4.5. Maybe it goes up to 4.7, 4.8. Maybe it goes down to 4.2, but it's not going to go crater down to 3.5, at least in my opinion. So what do you do?
The Morgan Stanley guys the other day told me that their guidance from the top of Morgan Stanley is saying like 3.5 to 3.75 end of year 10-year treasury.
Really?
Which they don't think is accurate. So it's like this, everyone's sort of like,
not sure.
You might as well think that it's going to go up a little bit.
Yeah.
This has got to be one of the most confusing and complicated times ever. I mean, we have a new administration. There's just unusual things happening. So like
flurry of activity.
It's everyone's guessing on a crystal ball.
Totally.
And so if you're a bank, do you want to continue to hold that risk, or do you want to say, hey, let's just end this, right? Get back our assets, sell it for whatever we can. Mm-hmm. If we get 80% of our loan, maybe that's better than if we continue to carry this risk forward. We know we're not going to get this interest, right? That is due to us. And then what happens if rates continue to go higher, right? If tariffs, come in and that's more inflationary, like we don't know. And so I do think that there's going to be a point where distress is coming. Yeah.
Well, and you were having conversations earlier today with lenders were coming back to the table to try to renegotiate certain terms and things. If coupled with that, there was a good business plan story operationally, because a lot of these were value add opportunities. And so if they were close or 3/4 of the way done with the renovation projects, they were seeing the rents, there are a lot of variables playing in that, because the inflation took a run so much that not only were rents higher because everybody was increasing the rents, but grocery bills doubled and other living costs doubled. So the storm of that then caused the business plan not to work out the gate unless they were almost done and they could prove to the lender that they had a strategic business plan that they felt confident to finish, right?
So
otherwise they really had to pivot, and the banks were less willing to kind of negotiate if they didn't like the business plan ahead of them.
So you're right. Do you finish your thoughts?
Yeah, no, that's kind of it in a nutshell.
So this is where we were talking with Tide. We're trying to figure it out, all collectively having fun right before we jumped on. And so you're right. But then the lenders hire brokers to go do broker opinion of values.
Right.
And they look at the current in place, let's say gross and net income. Mm-hmm. And then the BOVs came in 50% of the loan balance.
Which is where I think it pivoted to where it's it didn't make sense for the lender to come back and negotiate the terms. It didn't make sense. There were certain ones. And I think another point of this, or piece of this crazy puzzle, is that in the beginning, it was a handful. When it started to become millions and then trillions of dollars across different lenders. They can't have trillions of dollars of loans
Call it billions.
billions go upside down, right? Like if it's a few, they deal with it and try to strategize with these people and come to the table and negotiate and add the payments onto the back. But it's an interesting, I don't know,
but the banks sort of, they're sort of wanting to put their head in the sand and be like, please. Please, rents, come on. Like they're rooting for the operators, honestly. You know, like it's just, and so it makes sense that they would have extended. I just luckily didn't have to go through that and make that call. We were able to get out of our loans.
Yes.
But I could see why the banks were reluctant to go into foreclosure and push this through. Yeah. But then it was like they were so far now below, with cap rates where they're at, with revenues where they are holding or, you know, just been consistent in the last, let's say, year to two. They're looking at the NOI, the net operating income versus a cap rate. And with the additional expenses factored in now, and the rents that they were projecting on their performas they're like under what their probably in place rents were when they first went in, depending on when they bought them. It's like,
well, there were so many variables to all of this. They really couldn't push rents.
Were you saying too, Blake, that in your conversations with some of the bankers that they got back some assets, or there's assets that they know of that are sitting at a 3 cap based on the loan?
Yes. So if you were going to like, Tide's like, well, why wouldn't, if you're the bank, it's a good point. Why wouldn't you just hold them? You know, and what happened was everyone got so frothy on their underwriting for the projections that the projections didn't stick. Expenses went up. The rates have held longer at higher rates, meaning cap rates are now starting to adjust. Because if we were to look seriously at multi, or a company that really knows how to operate multi well and did not take this bait, maybe got into some construction pickles because construction debt was just live at the time. They would look at these and go, well, hold on, let me do the math. Net operating income divided by a 4 or 5 cap, depending on the market. Here's your offer. And it's like, let's say it's a $50 million building. They're coming in at like 25 to 30 million.
Yeah.
And the lender's like, well, hold on, we have a $40 million loan on it. You know, and you're only offering us 25, 30 million. And the guys that know what they're doing are like, yeah, interest rates today are the cost of equity. And by the way, insurance has tripled. And, you know, depending on where you're at, other things, property tax, the just
payroll, all the stuff Tide
name
knows.
it, the operating costs
utilities are up 15% year over year.
Yeah,
so you look at real numbers on a cap rate. And what I heard from somebody yesterday that's at the mortgage banking convention here in San Diego, they're all talking, is that there are banks holding the note, basically looking at going in or currently in foreclosure. And they're going, hey guys, what can we do with this? They've offered it out to guys, you know, to look at buying it, that are good operators that are still in the market to buy. And the offers come in at, and they're at like 5 caps. Meanwhile, the loan in place payoff, it would be a 3 cap on current NOI.
Correct. That's crazy.
And so the loan dollars are completely underwater. And you know, those lenders, who I'm now talking about isn't the agencies. That's bridge loans and debt funds that were maybe like 85, 90% of loan to value or loan to cost, depending on what they were doing.
Right.
So there was no room for an adjustment in cap rates, really. And those lenders, those are the guys that are going to also learn the risk at issue.
Yeah, I think just being, you know, my role here and what I do, I just feel so bad for the investors, really, you know.
Oh, yeah. I read an article that a lady put $1 million from their 401k.
You know how long it takes to get $1 million in your 401k? You know, if you're
your whole life. 7K. What's the max? 7K, 15K?
Well, yeah. Usually you're putting in, you're contributing 6% of your W-2 or maybe 10% of your W-2. Yeah. But most people, it takes a long time to go to $1 million, right? And you're like, oh, real estate's safe. And okay, look at this. And my nephew is works there or whatever it is, right? But yeah, that's tough. That's what I just feel for people that, I feel for the operators too, and I don't think they're being greedy, but I just feel bad for Yeah, I just feel bad for the folks that are, getting those calls. Hey, we need to contribute more capital, and maybe they even participate in some of those, and then it just eventually just gets wiped out. It's a position that I hope I'm never in. So thanks for never having to put me in that position, Tide and Blake and Jen.
It was funny because like early on when things were happening, the first questions are like, oh, we need to tighten, our tolerance and focus on operational costs. And I'm like looking at some of these assets, I'm like, it's running a 35% expense ratio. Like, just to put something in perspective, you might have a deal where maybe on due diligence, the fact that it had a section of bad sewer was missed, right? And so now you're replacing this as you have issues. Mm-hmm. That might be $30,000 to $40,000 a year that's hitting your P&L. Some of these impounds were like 30, 40 grand a month. And that's where I say it kills the deal. It's not operational, a fix. It's not a fix through operations. And then pair that with your consumer. Your consumer's out of runway. Their groceries have doubled. They've already, doubled the amount that they're spending on this rent that they're paying every month. There's no more money for them to pay. They make, 50 or 60 grand a year, maybe 2 combined incomes, whatever it is, depending on, what part of the country. You can't operate out of the bad debt. You can't.
Yeah. No, you're exactly right. You create a credit crisis, right?
And they created, really, the Fed going that aggressive, that was a multifamily credit crisis to the nth degree.
And we're seeing it on the credit debt tracking. Like, consumer debt is insane right now.
Mm-hmm.
Yeah. It is.
Well, and then, it goes all the way to like, Teslas now are 50% of what they were. And like, there's a ton of adjustments on values is my point. Like, it's everything.
Yeah. And so do you think if you're, obviously we're in the MHC space, but if you were an opportunistic person, would you say, hey, there's going to be an opportunity in multi in the next 1 to 2 years to go in as a buyer?
I think so. But I think that, you would need to really be sharp on the expense load, the understanding how to operate, what you can achieve, and what the real expenses are going to be on those buildings. And that's not an easy math equation.
Yeah.
So and so then you have to be buying at values that are so much more reasonable. Like, you can't, like, you and I've been racking our brain on rent growth. Like, what do we put out there for 10 years?
Yeah.
And it's like if you're buying apartments, let's just say a class B that's in good shape, but it's older.
Yeah. You run a negative 1 year.
Where are rents going?
Yeah.
Like, how would you make that assumption with any like reasonable certainty?
You almost just be like, all right, what's CPI? All right, let's just flag a 3%, and grow that every year. But that's not what you're seeing right now. You're seeing flat to negative, and it's difficult. And if you do that, are you competitive? And to your point, like what you're hinting at is like cap rates they've come up a little bit, but you're not seeing the distress. You're not seeing things that are trading at like a 6 cap, which I think is probably, they will.
They are coming. So, which is what I was going to say was that it's going to go back to normal math.
Yes.
Old school apartment underwriting where you have the income, you have the expenses, and you have a cap rate on the net operating income. And it doesn't really factor in a projected freaking rent growth.
Yeah.
Because that was the brokers, everyone made money and it's all good that got in and got out or whatever. But like everyone was pricing cap rates on at least 1 year of rent growth.
Yeah.
Mm-hmm.
So like it was NOI on the first, your first 12 months is actually $200K better. So then times a 4 cap is this, and then you had to execute it. Now, in the moment when it was good, that was achievable. Mm-hmm. And so you only had a very short period of time, months worth of income that was sketchy. But then now it's like, you're not putting any projections on this.
Yep.
It's take it as it is. And then it's icing on the cake on the swing if rents go back up, if you can charge more.
100%.
So you have to go back to simple math underwriting. And the banks, unfortunately, are going to learn that lesson. The guys that are like sellers, like that are good operators, or let's say historically owned mom and pop multi-assets.
Yep.
They probably have 3% money.
Yeah.
For another 4 or 5 years.
And their basis on the deal, they probably bought it, 6 years ago, 10 years ago. And so they're good. They're in the money.
So it's kind of the tortoise and the hare.
Yeah.
And the hare ended up wadding up and crashing.
I think this is the lesson is like, are you using practical underwriting and conventional sense? Because if you're not, then you need to, pay the $10,000 a year for the extra rate cap insurance and plan, because you're running in risk, even if everyone was doing it, it doesn't fly when it's other people's money.
I agree. And I think too, like something that I say a lot in our office and to investors is that we don't financially engineer returns. And I'm not using this as a pitch for our firm at all, but I'm just saying, like, we do not financially engineer returns. We keep it simple, stupid. This is a discount. This is fixing your debt, making conservative assumptions on a pro forma. And do we get dinged on it because maybe our pro forma returns are lower than what other people are out there advertising? Sure. Yeah. But I'd rather under promise and over deliver. And you fix the debt, you're having to raise more equity today. That's a fact, right? Mm-hmm. Fortunately, we're able to do that. And you know what? It's just real estate. You keep it simple. And it cash flows, it provides great tax benefits, and it's going to appreciate over time. And you don't want to get caught in these cycles where all of a sudden you look and you're like, oh crap, I took on a bunch of floaters because at the time I needed to get to that return to go advertise to investors, so then they would pony up the money. But when the Fed funds rate or when something happens in the market, it totally screwed up my real estate. It had nothing really to do with the real estate. It has everything to do with how I financed the property, which is what you pointed out. And you back into that through the expenses, think you're gonna have lower expenses, or through the rent. But it really is at a point in time, what are you buying it at, and how are you putting the leverage or the financing on that piece of property is really the two decisions that are so critical and really drive the returns, but also prevent you from getting into a financial crunch and losing an asset or losing investors' capital because you made a poor decision at a given point in time. And I understand why they did it, but still it is what it is.
They, like I said before, it hurts a deal when you operate poorly.
Yeah.
The underwriting kills the deal. And I think underwriting through that phase was inflated, aggressive, and wrong. Okay. That's a deal killer. Yeah. Plus, I mean, it's the proverbial black spot to have on the deal, to have both of those go wrong, because both of them can kill a deal.
Mm-hmm.
Yeah. I mean, we've internally wrestled with it, and we've come to the conclusion that we'd way rather, with interest rates being 5 to 6, maybe 6.5 on the high end in the last couple of years, we've wrestled and come to the conclusion we'd rather have more equity and staying power, call it more conservative underwriting to the expenses, to the, like, even padding the expense to where we think it might grow on hedging.
Blake's famous for saying throw another $1 million on it.
Learn the hard way. And then it's like, okay, so you pad. What we'll do is we'll take what's in place on the expense load, and then we'll hedge maybe depending on the item. Let's say insurance is the hot ticket right now. Insurance is really tricky, and then insurance companies are getting their butts kicked on losses all over in the storms and the fires. So you gotta understand that expense number year over year is gonna climb at a decent clip. So then we'll pad that in our understanding, and so what we'll do is we'll look at it real life, budget it, and then pad the balance sheet with a hedge. And when I say it's just a reserves and cash, basically our cash reserves have gone up substantially, just in case our expenses in a few categories go up substantially. And then we'd rather have lower loan proceeds, which reduces and simplify the loan product to make it really clean and simple for accounting, the extra costs associated with like the origination and the servicing, and the focus on just cash flow for the equity versus the growth. Because like our models are all to just have cash flow out the gate at a level, and then we think we can achieve the rent growth, but that is a projection and an assumption. And so as long as we're cash flowing day one, then we're fine.
Exactly. And then we've talked about this all the time. So you literally just hedged all your risk because you're buying and you're financing on a deal that cash flows today. But if rates go up, we're fixed. So it doesn't matter, right? But if rates come down, what does that offer you? It offers you the option to refinance. So you have low leverage and you could take on better debt, higher leverage. You could do a cash out refi to investors. So we'd rather avoid all the bad tail risk on rates going up, provide our investors with a safe, secure deal that cash flows and will grow over time just as rents increase and inflation and appreciation does its thing as it has over the last hundreds of years. And then if we do get a swing where rates come down, then can be in a position to take advantage of that through a cash out refi. So like to your point, that's what we talk about all the time. And I'd rather be in that position, and it allows me to sleep well at night. And I'm sure it allows our investors to sleep well at night. Yeah,
exactly. And I think another unique component of this as we're underwriting deals and projecting rents and rent growth, being in the mobile home park space is unique because we're kind of the tortoise behind the hare and we are lower than the multi. So we have a lot of rent comp data to look at to then further project where we think, mobile home park community rents are going to go and then be conservative on top. So it's like even further, I think it's risk adjusted because we can see where multi is going and see kind of where it's headed. Now, it's still a projection. We don't know what it's going to be in 10 years, but I think that's helpful for this particular space too, where it's a tougher job in the multifamily realm.
We would like sit back and be a year or two lagged and then be like, whoa, look at the rents.
We can push harder than we anticipated.
Like
that's good
the
news.
multifamily data would like boost like crazy in that moment. And we'd just be like watching it go. And then we just be like, okay, well, hey, we can next year put in a pretty good bump, and then we can start pacing. Right. But we were basically like probably at least a year to two lagged.
Yep.
Yeah. And we did really see an uptick. It's not like, first off, we're always one of the more affordable options compared to our competitors. We're never the most expensive. And what we were seeing too was a raising of baseline costs from an expense standpoint. When I first started, I remember if the plumbing repair was above ground, it was under $1,000. If it was underground, it was going to be around $1,000. And if it was in the street, it was $1,500. That was kind of my okay, a main line broke. It's in the middle of the street, $1,500. That's a $5,000, $4,000 repair sometimes right now. And you get multiple bids and they're all the same cost, So it's one of those things where we saw expenses go up everywhere too. So we were allotted the ability to resolve our expense ratios through rent growth, fortunately, in that type of scenario. But it wasn't like, oh, now we have this opportunity and our expenses are still low. Now we're going to make crazy buku profit off of that. That's not what happened in that scenario.
Yeah, and Tide and I had been talking about it for the last couple of years, but you should look at, and then Ben, you touched on it. If you're holding on and hanging in there, look at this even real time as your time in the fire, because this is your time in the fire and you will only go up from here and you will experience so many cool lessons learned through this. And we've kicked it around like it's probably even overdue, but let's say now's the best time to sort of get the ship readied for battle, going into uncharted territories. Because we don't know what is to come now more than any time, like with Trump in there, like bashing things around. I particularly am really interested to see what comes of this.
The Great Reset,
but
people are saying.
Interesting. Like there's going to be variables. There's going to be losers. There's going to be winners. Yeah. So it's like prep everything, hedge twice if you can.
We did that last year. So we set up a finance committee, and what we did was we got underwriting with our financial controller and we laid out every single deal from a 10-year projection. And we looked at what deals were not performing to where we wanted them to do. And we trimmed a little bit in our portfolio. We also looked at debt product that we have. All of those floating rate debt has all been refinanced, restructured. And we planned and looked at what are even if it wasn't necessarily a deal that wasn't doing great, what would be wins so that we are having staying power. We are in a financial position to weather a storm if it doesn't get better over the next years. And I think ultimately, word to the wise, we're learning, but this is the advice we would give any other operator is you have to be prepared. Ultimately, a cash constraint issue that happens at the operator's level might drive decisions that you don't want to be making if you're a financial fiduciary for investor capital. And so you got to spend the time. If you haven't done it, get with your people, look at your product and see how can we really bolster our, what we call the war chest, and make sure we're stable in case things don't get perfect.
Exactly.
I think that's a good point to just maybe stop on. I like it.
I know.
Yeah.
Let's wrap. Thanks for joining us for the Multifamily Meltdown. It's an interesting time to be alive, and we appreciate you tuning in to another episode of the CashFlow Quest. Cashflow's king.